Okay, good morning. We are going to get started, and to get started, we have someone here, Kel from the College of Business Career Services. So I'm going to let her talk for a moment. You're live.
Good morning, everybody. My name is Kel Krakowski. I am a career advisor over in the Career Services office here in the College of Business. We're located in A309, and I just wanted to make you aware that there is a job fair coming up, job and internship fair on October the 28th. It's Wednesday from 12 to 4. It's over in the Student Center. It's in the ballroom. There are about 140 employers that will be there. So if you're thinking about getting an internship or seeking a job, I highly recommend that you go, because if you wait until the spring, you're already too late. Right now, recruiters are recruiting for the spring and summer, so think about going. I want to let you know that we have drop-in hours Monday through Thursday, 1 to 3 p.m., again, A309. And also, you can make an appointment in case you're advising, so you're more than welcome to do that as well. Some other services that we offer are cover letters, mock interviews, job searches, internship searches, also anything to do with, if you're not sure what to do within your major, we can help you with that as well. So we just wanted to let you know that that's coming up. It's a great opportunity. Can't get any easier than employers coming on campus if they want our students. So we just want to help you better prepare for that, so feel free to use our services. That's what we're here for. So any questions for me right now? And if not, you're more than welcome to drop by our office or make an appointment with one of us. Yes? It's for all majors.
The question was, is the career fair for all majors?
It is for all Kent State University. Usually there's about 1,000 students and alumni that go through there, so definitely a good opportunity to take advantage of. Anything else? Yes. What time is it? It's from 12 to 4 on October 28th.
We have a question online. Is there a dress code?
We highly recommend that you come in professional attire, so that means a suit. Have your resume ready and on resume paper. Again, if you're not sure, if you've never been to one, it's a little nerve-wracking. There are a lot of recruiters, but they're excited to talk to you. So, you know, come to our office, have a conversation with us. We will prepare you so that way you feel good and comfortable about going into the fair.
So if someone would come to see you today between 1 and 3, you can talk about, you can answer any questions on a one-on-one basis?
Absolutely. More than happy to. All right. Well, thank you so much for your time. I appreciate it. Oh,
wait.
I'm sorry? October 28th, Wednesday. Sorry.
Oh, okay. We didn't have the date up there. Okay. October 28th. What day of the week is that?
Wednesday.
Wednesday, October 28th from
12 to 4.
12 to 4. I bet you.
Oh, thank you.
We're good.
All right.
Okay.
All right. Well, thank you so much. Appreciate it.
Thank you for coming. Come in anytime.
Thank you.
Okay. You good? Okay. Okay, so today we're talking about, we're working our way down the balance sheet. A couple of weeks ago, we started up near the top, not at the top, we're coming back to cash, but we started with short-term investments, and then we did receivables, and last week we did inventory, which is another short-term asset, and now this week we're doing something called property, plant, and equipment. Property, plant, and equipment, plant assets, we can abbreviate it. It covers these assets which we buy or construct for use in our business, not for resale, but assets that we use in our business. And these are things like land, automobiles, buildings, computer networks, things that are big ticket items that last for a long time. And so as we move down our balance sheet, we're leaving current assets, and now we're starting into long-term assets. So we are okay, well, I can probably still talk while you're connecting, right? No, okay. I might leave the question, but it's still going to be open for a couple minutes, okay? So So we're talking about this category of property, plant, and equipment in today and Wednesday. So we're moving our way down the balance sheet, and now we're into long-term assets. So that's just kind of an overview of where we are. This question will be open for a few minutes. I'm not going to announce when it's shut, but it will be open. So if you're just joining us, make sure you get logged in. We already heard from Career Services. So what's due this week? So this week we have Chapter 7 homework due. Again this week, I think I'm going to send out today or tomorrow, later today or tomorrow, I'm going to send out videos for all the homework step by step, so you can start it earlier if you wish, or when you refer to it, you can go to the step by step instructions for that. So I'll be sending those out probably early tomorrow morning. But the Chapter 7 homework is due this weekend. Now, Exam 2, I just want to mention it today. It is coming up. This week, we have Chapter 7. Next week, we are doing Chapters 4 and 8. So 4 is a very short chapter. It's about cash and internal controls. 1 day in class on it. Chapter 8 is also a very short chapter, so we'll have 1 class day on it. So 4 and 8, 2 chapters in 1 week is not unreasonable. Actually, it'd be fairly short homework next week. So the following week then, November 2nd through 4th, is our Exam 2. The reason I'm bringing it up today is if you are in Section 7 or 8, you want to schedule your exam with ProctorU as soon as possible so you get the best selection of time slots. And again, you have to schedule it at least 72 hours before you take it. You can also, as an aside, if you're in Section 7 or 8, the online sections, you can also schedule your final exam. That's available to schedule as well. So by scheduling early, you get the pick of the best time slot to the most time slots. So this week is Chapter 7. Our exam will be over Chapters 4 through 8, so everything we've done, but Chapter 7 this week. So we'll just get started. But I did want to mention that. So if you are taking your exam using ProctorU, just a gentle nudge to schedule it so you get the time slot that you want. Okay, so this chapter is about property, plant, and equipment. So we said this is things like buildings, equipment, land. We also are going to briefly, the chapter talks about natural resources. Natural resources are things like timber, salt, iron ore, things that you take out of the land or off the land to use. And natural resources are a slightly different category, but they are considered a long-term asset. And then intangibles. Intangibles are things that give us legal rights. Intangibles are in the news a lot about patents. So we see Google and Apple and Microsoft have millions and millions and millions of dollars of patents, and those are called intangible assets, and this chapter speaks briefly about those. So our main emphasis will be the plant assets. Okay, another example of a plant asset in real life. So Walt Disney World has a lot of plant assets. We call this category plant assets or property, plant, and equipment, or sometimes fixed assets. There's lots of names for it, and companies will call it slightly different things. But here's an example of property, plant, and equipment. Again, common abbreviation is PP&E. So when you see that, that's what that stands for. Walt Disney recently released a press release. What they did is they said, we've designed and opened this new interactive queue for Peter Pan's Flight in Magic Kingdom in Orlando. Now, what they're saying is the lines for Peter Pan's Flight are long and you have to stand in line. So what they did is they constructed this interactive waiting line, and you can interact with Tinkerbell, and it's some virtual reality in there, and Tinkerbell will interact with you, things like that. But that is a plant asset for Disney, and they would be able to depreciate that, and we'll be getting to that probably on Wednesday. So there's several categories of property, plant, and equipment on Disney's financial statements. This is a screenshot, just briefly, of Disney's balance sheet. And when we look at Disney's balance sheet, nothing to memorize here. It starts with current assets, so it lists cash, receivables, inventory, those kind of things. And then when we move down, we get into Disney's property, plant, and equipment. Disney does not call its property, plant, and equipment exactly. They call it parks, resorts, and other property. And that makes sense. That's what Disney is. And we see they list the first name is the attractions, building, and equipment. Attractions, building, and equipment, those are their plant assets, or the property, plant, and equipment. Then we have an account called accumulated depreciation, which we've seen briefly in an earlier chapter. That's a contra asset, and we'll see that on Wednesday. And then projects in process, those are things that Disney's building, new attractions it's building right now, and then we see land. So these are things that show up on companies' balance sheets. They are long-term because they last more than a year. The company uses them in their business. These are not typically offered for sale. So it's not inventory items. These are things we use in our business. Okay. So the first thing we're going to do when we talk about this category is talk about the cost, how we come up with the cost of these items. This is Exhibit 7.1 in your textbook, and there's a couple things. This is kind of terminology before we get too far with it. Now, when we talk about this category of property, plant, and equipment, we can kind of separate it into general categories, and the first thing, when we talk about land is a special case. Land, this chapter we're going to be talking about how we take the cost of an asset and how it's called depreciate it over time, and the cost of that asset shows up on the income statement ultimately. There is one type of asset that never gets depreciated, that's land. So you want to make a big note. We'll see it again. I'll mention it a couple more times. Land is never depreciated. Land is a special case. We say that land doesn't wear out. We make that assumption that land will still be here. 50 years from now, this piece of land will still be here. Now, we might take lumber off of it, and that's a different issue. We might, if we take things out of it like we mine it, that's natural resource, and there's accounting for that. But when we buy a piece of land, it's still going to be there 50 years from now, 100 years from now. Someone in the earlier class had an interesting question because they said, what if there's a natural disaster and land is swallowed by the sea, for example? That's a loss, and that's way beyond the scope of this class. I'm not sure we'd even get into it. Did you get into that in corp accounting? Probably, yeah. Okay, so if you're an accounting major, you'll get into that. We're not worrying about when land disappears because it's a rare occurrence. So land is a special case. But then we have the rest of these, buildings, furniture, fixtures, land improvements, things like that. That's not an exhaustive list. But those items have depreciation. So when we talk about buildings, equipment, furniture, fixtures, land improvements, building improvements, whatever the case may be, those things have depreciation expense. So when we talk about the asset on the balance sheet gradually gets, the cost of that asset goes to depreciation on the income statement. And this is just terminology. Natural resources, things like timber, mining for salt, mining for iron ore, things that we take out of the land or off the land, those are depletion. So the term with natural resources, just recognizing the terminology, is depletion. And they work very similarly, depreciation, depletion. It's just depletion deals with the natural resource. And then finally, intangibles. Intangibles are things like patents, copyrights, things that give you legal rights. It's not typically an intangible you can't touch or feel or see, but it gives you a legal set of rights. If you have a franchise license, that's an intangible. Those get amortized, so amortization. So these are three different terms that are kind of included in this chapter, but depreciation deals with the plant assets, except land. Depletion deals with natural resources, and amortization is intangible. So that's just terminology, so you know what those terms match up with. So we're going to talk about the cost of a plant asset. So a big chunk of today is determining how much a plant asset costs, or what is included in the cost of a plant asset. So the cost of that plant asset is the sum of all the costs needed to bring that asset to its intended use. So this would include the purchase price. It would include any taxes we pay, any commissions, any other amounts we pay to make the asset ready for use. So this is not a complete list, but these are things when we think about making our asset ready to use, those are included in the cost. When we talk about land, the cost of the land includes the purchase price, less any discounts, or, if they list it for sale for $100,000 and you buy it for $95,000, the cost is $95,000. Now the purchase price, it doesn't matter if you pay cash or note payable or some combination thereof, it's the purchase price. Any brokerage commission you might pay, survey fees, legal fees, back property taxes that the purchaser pays. And then this is pretty important. When you buy land, it also includes any expenditures for grading and clearing the land or removing unwanted buildings. So let's say you buy a piece of property and you have to remove an old building before you build a new one. The old building is part of the cost of the land. Yes. The land will stay on your balance sheet as long as you own it. The question was, does land just show up on your balance sheet? Yeah, every year the land if we buy land for $3 million, it will stay on our balance sheet for $3 million. And we'll talk about I know what you're getting to. You're talking about what if the land value fluctuates? Is that where you're going with this? No, it doesn't change. It will be if you pay, and I'm going to wait for people to quit writing, and then I'm going to follow that line of thought. So thank you for asking that. Okay, so the question, we'll hop to that actually. So when we pay for an asset, so any of these assets that we talk about today, land, building, equipment, we account for them using the historical cost. So, for example, the example we had here was land. We paid $3 million for land, so we just made up the $3 million. So we paid $3 million for land last year. It goes on our balance sheet at $3 million, and then it's going to stay on our balance sheet for $3 million. The cost, we use the historical cost principle in accounting, meaning that we're going to record things for the historic cost. We're not going to adjust them if the market value fluctuates. And the reason is this. The market value cannot be, it's fuzzy, it's gray. And if we were to say to companies, oh, go ahead and revalue your land, we don't care what you paid for it, figure out a value for it this year, that's a gray area. We can get together 6 appraisers and they're going to come up with 6 different values. So U.S. GAAP says No, you're not going to revalue your land. You're just going to keep it at the original cost. As a user for the balance sheet, when I look at it, that's what I paid for it. It's going to stay on the balance sheet. A building, same thing. Whatever we pay for a building will stay on the balance sheet. So it'll stay as long as you own it. The cost, you are looking at the historical cost. Now with buildings, we are going to take depreciation, and that goes in a contra asset, which we'll get to. So any depreciation goes in a contra asset, but in the original asset itself will stay our purchase price. As a side note, international financial reporting standards do allow or expect revaluation. So revaluation occurs international financial reporting standards, but not U.S. standards. And we're using U.S. standards here. So when we record it, it's going to stay at its original cost. Okay, so land. So we talk about the cost of land. Why do we care what's in the cost of land? The reason we care is because if it's in the cost of land, it's always going to sit in the cost of land. It will never be deducted. We'll never have it be an expense on the income statement. It's going to sit in the cost of land. So this last category, expenditures for grading and clearing. So we buy land, we have to clear woods off of it, maybe clear the rocks off of it. We have to clear an old building. All those things to prepare it for its intended use are part of the cost of land. Okay, so I'm going to do an illustration here. Okay, so we have FedEx signs a $300,000 note payable to purchase 20 acres of land. So FedEx spent $300,000, signed a note payable for this land. They also paid $10,000 for real estate commission, $8,000 of back property tax, $5,000 for removal of an old building, $1,000 survey fee, and $260,000 to pave the parking lot. So what's the cost of this land? First of all, the purchase price. That's an easy, we know that that's going to be part of it. Then we have $10,000 for real estate commission, $8,000 of back property tax, $5,000 for removal of an old building, that's part of the cost of the land, a survey fee. Now, we get to the $260,000 to pave the parking lot. A parking lot is added to land. It is not part of the land itself. A parking lot wears out. Land does not. A parking lot does. So a parking lot is actually considered a land improvement. It's an asset, and it's in a separate category. So the parking lot is not part of the cost of land. The parking lot, things like parking lots, lights, sprinkler systems, fences, those are all things that we add to the land that wear out. So they are put in a category, an account called land improvements, and they are depreciated because they wear out. A parking lot absolutely will wear out. So it doesn't get added to the cost of land. Even though it's sitting on the land, it's not part of the cost of land. So in this case, what's the cost of this land? $324,000. If we add all those up, that's $324,000. And when we do the journal entry for this one, we're going to be debiting land for that $324,000. So that was all the costs showing up there except not the parking lot. And then we'll credit notes payable for $300,000, and then we just assume that cash is paid for the rest of those. So the $24,000 is the $10,000 plus the $8,000 plus the $5,000 plus the $1,000. So land's pretty. You need to make sure that you've included all the costs of land, but not things that have been done to improve it. And improve it is things that you're adding to the land. If you're removing an old building, that is not an improvement. That's part of the cost of the land and getting it ready for use. Okay, I've got some examples of some plant assets, some different categories here. So, first of all, this is a mock-up of Apple II headquarters, and they're building this. and this is actually pretty amazing. This building is meant to be totally sustainable, so it has, they're using a lot of sustainable energy for it. But this building is 175 acres in size. It is a mile in circumference, and it's designed to hold, it will hold 12,000 employees when it's done. So this is Apple's building. So they would have an account called building. Now, when they cleared out the trees to build the building, clearing the trees was part of the cost of the land. But when they brought the excavators in to dig the foundation for the building, that's part of the building. So clearing and grading the land to flatten any existing buildings, that's all part of the cost of land. But when they actually start digging the foundation for the new building, that's part of the building. Okay. Also, I guess I could talk briefly. So if Apple has loans to build the building, so they're paying contractors if they have any loans outstanding, the interest on the loans is also part of the cost of the building. So everything they incur before the building's ready for use becomes part of the cost of the building. This is in New York City. It's Google's, one of Google's buildings, and this is an enormous building. It's a historic building, and Google bought this building and is renovating it inside for the use by their employees. It's going to house thousands and thousands of employees as well. Now, so Google bought the building in this case, and then they went in and they're remodeling it, seriously renovating it for their use. All the costs of those renovations are part of building improvements. So they have the building, and then they might put it in building improvements or building, but it's part of the cost of the building. This is a picture from inside the Tesla, one of the Tesla factories, and this is a robot. A lot of their cars are built by robots. The robots are part of Tesla's equipment on their balance sheet. So the robots, and when we talk about the robots, it's the cost of the robot, but once we get the robot, we have to have it delivered to us. So Tesla would have had the robot delivered to them, so the cost of the equipment, the robot, would be the purchase price, plus the cost to get it to them, the freight to get it to them, plus the cost of insurance. These things are, when Tesla buys a robot and has it shipped across the country, they are insuring it from the time they get it until they get it in. The cost of the insurance is part of it. The cost of installation, it's very expensive for them to install new robots. That installation is part of the cost of the equipment. So basically, it's everything up until the point of when it's ready to use. When they flip the switch and the robot starts building cars, then that becomes something else. But all those costs up to that point are part of the cost of the robot. Okay. Oh, this is a building in San Francisco. This is the Twitter building. So Twitter resides in the upper floors, and so that is the cost. When they bought the building, they renovated it for their use. So Twitter has the building, okay, and their renovation costs are part of the cost of building. But on the lower floor, they have rented it out for several different restaurants and shops. And one of the big tenants in the lower part is the market. And this is the Twitter building. The tenants in the Twitter building are actually, these are well-known good restaurants that they put in here. And so the market, for example, is in there. And they went in and they did extensive renovations to the space to make it their own. So they put in walls and they put in counters and they put in new lighting and new flooring. So the tenant also has something called leasehold improvements. And so you don't have to own the building to have an asset. So the market has improvements to Twitter's building. So Twitter owns the building, but the market probably has a 30-year lease, and so they've gone in and made renovations. So they have a long-term asset called leasehold improvement. So those are just some examples of some assets. So let's go with another question here. And so this one, before I put it up, ABC Company purchased land with an old building that it plans on demolishing so it can construct a new modern building. The cost of demolishing the old building. So ABC Company bought this piece of land, it has an old building on it, and they need to tear down the old building. So the question is, how is the cost of demolishing the old building? So I've just sent the question out. Okay, pretty good so far. So when we talk about this, so ABC Company buys this piece of land. The rule for land is everything that's in the cost of the land is what we paid for it, the real estate taxes, the commissions, anything like that. But also everything to get the land ready for us to use for something else. So that includes clearing and grading the land. Clearing includes demolishing old buildings. So when we're talking about cost of land, it does include clearing any old structures off that are already there. So you're going to have about 20 seconds left to answer this. Land improvements are not, clearing the land is not a land improvement. A land improvement is something like a parking lot or lighting, the big lights that they put up, or fences. Land improvements are things that we add to the land that wear out. Land itself is going to include the purchase price, any real estate taxes paid, commissions to sales agents, real estate agents. It's also going to include the cost of clearing the land, and clearing the land could be clearing out trees, clearing out rocks, but also clearing out old buildings. So when we talk about the cost of the land, including all those items, the cost of demolishing the old building is not a land improvement. Okay? So the cost of demolishing the old building is not a land improvement. Let me see, where else? Okay, so we're at about 83% correct. The cost of clearing the old building is not part of the cost of the new building. Okay, so it's not part of the new building. We don't even, when we buy this piece of land, we have land, okay? There is no old building on our books. When we buy the land, it includes everything. Here's so basically on this one, it can't be, it's not the new building, it's not the old building, and it's not the land improvements. Then closing in 10 seconds. Okay. So that's absolutely part of land. Okay. So cost of a building. Just these are not a complete list, but just ideas of things that would go in the cost of a building. If we're going to build it, it's going to be building permits, the things that we pay our contractors, the purchase price, brokerage commission, sales tax, renovations and repairs to get it ready for use. So we can go in and we might have to repair the heating system. That's part of the cost of the building before we can use it. So all of those things can go into the cost of a building. Now, if you're an accounting major, this distinction between building and building improvements is important. We're not going to focus so much on that. So we'll say it's part of the cost of building, but know that if you're an accounting major, it does matter down the road whether it's building or building improvement, but we're not going to focus on that distinction. So basically, building, the big distinction for us, is it building or is it land or is it equipment? So we're not going to split hairs between building and building improvement. Cost of equipment. Cost of equipment is our purchase price. Of course, we subtract any discount we would have received. The transportation from the seller, so if we have to pay the freight to get it to us, that's part of the cost of the equipment. If we have to pay for insurance when in transit, yes, that is absolutely part of the cost of that equipment. Any taxes we pay, the installation cost to get that equipment up and running. Everything until we flip the switch where the equipment's in use, pretty much everything up to that point is included as part of the cost of the equipment as a rough rule of thumb. Yes. What do I mean by insurance while in transit? That means when we buy the equipment, if we buy it in the title transfers when it gets on the delivery time. You know, sometimes you can, if you buy something, make a purchase off of eBay, for example, and the seller can say, do you want insurance on that? You know how you're insuring it but while it's traveling to you? Okay, so insurance in transit is just saying you're insuring it, so if there's any damage during the shipment process to you, that you'll get reimbursed. So the cost of that insurance is part of the cost of the equipment if you do that. Yes, it's insurance while it's coming to you. In case there's damage, in case it gets damaged when it's on the truck. Okay, and then one final one of these categories. Again, these aren't complete exhaustive categories. If you're an accounting major, you'll see a lot more of this later. Land improvements. So land improvements are things like driveways, signs, fences, sprinkler systems, outdoor lighting. Those are all things we add on the land that do wear out, so they're considered land improvements. We do depreciate them. Land is never, ever depreciated. Then leasehold improvements. Just like when Twitter has its building and it leases out the first floor, the market where they can make improvements to the first floor, they depreciate those. Those go into an account called leasehold improvements, and they're amortized or depreciated over the term of the lease. So if they signed a 30-year lease, they'll be depreciating them over the 30 years. So you don't have to own the property to have an asset. Just depends on, yes. If someone leases out the floor of a building and puts in their own improvements, we depreciate that. Amortization is something else. It's not, in that example, that's depreciation. Amortization, just rule of thumb, is an intangible. So amortization would be like you amortize a patent, you amortize a franchise fee, you amortize copyrights, things like that. Okay, but if you're talking about physical improvement like a wall or floors or lighting, that's depreciation. I'm sorry, why does it go down? What? Okay, so you have the cost of the asset and you spend more, so it keeps it. Now this is remember that accounting, we're talking about the cost of items. So we have the cost and we add cost to it and add cost to it. The cost of the asset is always going to stay the same. When we depreciate it, we're saying this is a systematic way to take this cost of the asset and spread it over the asset's life. But all that depreciation goes to the income statement and it goes into a contra asset on the balance sheet, which we'll get to on Wednesday. But the cost of the asset will always be in the asset itself. We'll have something else going on over to the side to get it onto the income statement. But we're going there. But right now we're just like, here's the cost, it's going on the balance sheet. That's today. Okay? So then Wednesday we're going to say, how do we get the cost from the balance sheet onto the income statement, and that's another conversation. But the costs will always stay in the balance sheet in those original accounts. We're going to use another account for the other things that we're doing. Okay. Okay, so we're going to do a couple questions here, I believe. So, the first one, the cost of land may include the cost of any back property taxes that the purchaser pays. True or false? So let's see how this one goes. The cost of land may include the cost of any back property taxes that the purchaser pays. Early returns are really good. Okay, the cost of the land may include the cost of any back property taxes that the purchaser pays. So when we buy land, sometimes the seller has not paid the real estate taxes. To do a real estate transaction, property taxes have to be paid up. So if you're buying real estate and the seller has not paid the taxes, before that transaction can occur, before you can own it or part of the purchase, you have to pay off the back property taxes. So that would be included as part of the cost of that land. Okay, so any taxes you pay as part of the purchase of the land are considered part of the cost of that land. I'm going to close this question in about 5 seconds. Okay, so the next one. Company A purchased a used piece of equipment. Okay, so Company A has purchased a piece of equipment. All of the following costs should be included in the cost of the equipment except for, so of this list of 4 items, you have to pick the one item that would not be included in the cost of that equipment. Okay, Company A purchased a used piece of equipment. All of the following costs should be included in the cost of the equipment except for. Okay, so as we run through this list, I'm going to close the question in about 10 seconds, so make sure you've got your answer in. Okay, so insurance while in transit. That's the cost of insuring it while it gets to that. It gets to us. That is absolutely part of the cost of the equipment. Sales tax paid on the equipment, that is absolutely part of the cost of the equipment as well. Installation costs, yes, those are part of the cost of the equipment as well. So we get to the last one, okay, and this is, we've got the equipment all set, ready to go, we flip the switch and we start using it, okay? So the repairs and maintenance after we start using it, that's no longer part of the cost of the equipment. So, so we're going to close this, 5 seconds. Okay. Okay, so again, maintenance costs after the equipment is up and running. Okay, so one more question right now before we go on. Company B purchased some land, is preparing the land for a new building. So they purchased this land and they want to build a new building on it. They knew that when they bought this. Company B should include which of the following in the cost of the land? So we have the cost of driveways, the cost of fencing, so these are new things, cost of sprinkler systems for the shrubbery, or grading and clearing the land. Okay, so which of those items should be included in the cost of the land? So earlier we talked about land. It's not going to include things like well, let me go over this from a different way. When we talk about a land improvement, which is something separate from land, we're talking about things that we add to the land. So things that we can add to the land would be driveways, would be fences, would be lighting, would be signs, would be driveways, fencing, Okay, sprinkler systems, those are all things that we add to the land. Those are considered land improvements, so they are not part of the cost of the land. So we're going to close this in about 10 seconds. Question up there? Question? Do you have a question? Did you have a question? I heard you talking. Do you have questions? No? Yeah. Okay. Anyone else? Okay. So grading and clearing the land is part of the cost of land. The other items are land improvements. Okay, now, so we talked about the things that are part of the cost of different assets. Next up, what happens when we buy something and it includes more than one asset? Classic example, if you go buy a building, you're buying the building and the land together. So when you buy the building and the land, you can't depreciate the land, but you can depreciate the building, but it's one purchase. You buy, when you say, oh, even on a personal level, I bought the house, just bought a house. Okay, great, we bought a house. But the house includes land. So you need to somehow allocate the one purchase price between the two things you bought. Common in business to say, okay, we're going to buy this building and we're getting the equipment too. So you've got equipment, you've got a building, and you've got land. So you've got three things you bought, and how do you value them? So you have one purchase price. So what businesses do is they have a market value, an appraised value of each of the individual pieces, add that up, and get what percentage the market value of each piece is, and then allocate that. We're going to do an example here. But this is called the relative sales value method. So we're going to step through the steps on how to do this. Okay, we're going to do short exercise 7-2, and that's illustrating how to do this. So we make a purchase, and this is so common. And also, if you ever plan on buying, like if you're going to own a business and you go to buy a building, you absolutely have to do this. You buy a building, it has land on it, you've got to pull the value of the building, the land out of it. If you have, well, that's getting too far into taxes. Okay, so anyways, you can't just say, this is what I purchased. What? Just that if you buy a building, you can't depreciate the land for taxes. So you have to allocate it between the two. So this is part of it's for your financial statements, but part's also for taxes. You cannot depreciate land. If you buy land, you're not taking any expenses on that. You can't depreciate it. But if you buy a building, you can take a certain amount of depreciation every year on your taxes. But you have to allocate it. You do something similar to this. Yeah. You get tax write-offs for depreciation. The IRS has its own schedules and methods for depreciation, and we'll talk about that when we get to that Wednesday. But yeah, so this impacts taxes too. Okay, so short exercise 7-2, we're going to do it. So an example of this. So we have a company that pays $320,000 for a group purchase. So the numbers, if you're writing down numbers, they paid $320,000, and so that's what they paid. Now, what they bought was they bought a building that's on land, and they have equipment in the building. So we have three things they bought. Land can never be depreciated, so it has to be separated. The building has a much longer life than equipment. If you think about equipment may have a life, depending on the equipment, 5, 10 years. A building, we might say, has a life of 30 years or 40 years or whatever it is. So we have three assets they bought. When they have at the time they bought it, the land has a current market value of $112,000. The building's current market value is $225,000, and the equipment's current market value is $10,500. So we bought it for $320,000, but when we add up the market values, the $112,000, the $227,500, and the $10,500, when we add all those up, we get $350,000. So this is common. If you would do an appraisal of the individual pieces, they're higher, but finding a buyer for the individual pieces may not be possible. So often you negotiate to get a better price. If you say, I'll buy all three items, the land, the building, and the equipment together, so you get the $320. But the appraised values are typically higher, the appraised values of the pieces. So what we're looking for is what percentage of the appraised value is each of those items, okay? So we know the total appraised value of all the things is $350,000. So now we're going to say, okay, so for the $350,000, land has a market value of $112. So we'll take the $112, divide by $350, and we get 32%. Okay, so in theory, 32% of our purchase price was for the land. The building, $227,000 of the $350,000. $227,500 of the $350,000, so 65% of the purchase price is land. And then equipment, $10,500 was 3%, and when we do that, we have 100. So we've just said of the $350,000, we've got it allocated the percentages for all those. They add up to 100%. So we haven't done the journal entry yet. What we've done is we've done the preparation work. We're saying what percentage of the market value is each of those assets. So again, I'm going to jump in as you're typing. Yes, I'm going to repeat it again. Okay, so that $350,000 is the total of all the market values of the assets. So that's that $112,000, the $227,500, and the $10,500 all added together. So we added the market values. They're $350,000. We only paid $320, but we're trying to see what percentage of our purchase was each item. So now what we're going to do, so this right here, you have this homework problem, and this is a pretty common question because we get confused. So you have to go step by step and say, okay, this is my market value. I'm looking for the percentage. Your percentages, to know you did it right, if you add your percentages up, they will equal 100%. So if you use the right numbers, you'll have 100%. And now what we're going to do is we're going to say, okay, land. Land is $320,000. Now that weird symbol in the middle there, that's what you get when you switch sometimes from, I do my PowerPoints at home on a Windows machine and I come to class with a Mac. So for whatever reason, this font set changed my multiplication symbol to that weird piece, the weird symbol there. So that's 320,000 times 0.32. You're going to see that consistently on this whole slide. And I didn't have the tools here to change it. So 320,000 times 0.32. Where did I get the 32? The 32 was this relative, this 32% here, 32% of my purchase was land. So I took the 32, the 0.32 times, okay, so it's times the 320,000. So again, that symbol on this slide will always mean multiplication. So 102,400. Now the next one, building, I'm going to do the same thing. So building, again, 320,000 was the purchase price times the building's percentage, 65%. So again, 320,000 times the 65%, and again, that symbol is the translation. It's a multiplication symbol, or it should be. And equipment, 320,000. So what we've done here is we've said, here's the, of our total purchase price, of the 320,000, we have 102,400. It represents the purchase price of the land. So of the 320,000, I know that 102,400 of it was for the land. The building, 208,000, that was my purchase price of the building itself. And then the equipment, 9,600. So we've calculated, of my total under 320,000 purchase price, here's how much is being allocated to the purchase price. So we've just calculated, of the 320,000, how much is to each asset. And then we've actually done the journal entry. We signed a note for this. And actually, I'll clean it up here. Remember, these are multiplication symbols. Okay, so this is our journal entry. The problem asks for a journal entry, so we're going to debit land for the 102,400. We'll debit the building for 208,000. We'll debit equipment for 9,600. So then we add that up in our credit. What we paid is 320,000. We signed a note payable for this. Okay, and it tells us in the problem in the last sentence that we signed a note payable for this amount. So that homework problem is on your homework. And it's not too bad, but you have to keep the 320 separate from the 350. You're just saying, okay, I've got these market values. What percentage is allocated to each asset? Okay, on that. So what I'm going to do right now is I'm going to put up a question, and this question asks you to do exactly this. So I'm going to put up the question, then I'm going to come back to this in case you don't have everything written down in your notes. Wrong direction. Okay, so what we have here is we have land, building, and equipment are acquired for a lump sum of $850,000. So our purchase price is $850,000. The market values of the three assets are respectively. So what that means, when it says respectively, it says they're listed in the same order as they are in the first sentence. So what this is telling us, land is $250,000, buildings are $480,000, and equipment is $180,000. That's what that word respectively means. What is the cost assigned to the equipment? So you're going to have to do a little bit of work to get this answer. I'm going to send it out now. And I'm going to, you're seeing this, but I'm going to switch back to the homework problem solution just so you have that in case you want to reference it. And so I'll give you a minute or two to do this. It'll take a little bit of, and those are multiplication symbols again. Okay. If you selected an answer that you didn't have to do any math for, it's wrong. Okay. So if you need to get started on this, you need to add the three market values together. So you need to add the 250,000 plus the 480,000 plus the 180,000. You add those together, that'll give you the 910,000. So that 910,000 is going to be, that's like what the 350,000 we used in this problem was. So you add the market values together for this problem, you get 910,000. So that's like the 350,000 here, and it's asking you how much you're going to allocate to the equipment. So you take the equipment, market value. The equipment's market value is 180,000. So you would put 180,000 divide by the 910,000 in your calculator. Now I would just leave that in my calculator. Don't round it. I mean, if you round it, you'll have a little bit of rounding error, but you'll pick the answer that's closest to it if you did some rounding along the way. So you're going to be, going in here. Okay, so I've added the 250, the 480, and the 180 together. I got 910,000. I'm going to take the 180,000, divide by 910,000. Okay, so I get an answer in my calculator. Okay, so that answer, I'm just going to hit the multiplication symbol, and I'm going to multiply by the 850,000. At that point, you will have the answer. So it's 180,000 divided by 910,000 times 850,000, and you'll get the answer. Again, if you do any rounding, you'll be off a little bit, but there'll be no answer closer. Okay, so final chance here. So you're taking 180,000 divided by 910,000, multiplying by the 850,000. I'm closing the question in about 10 seconds, so you want to make sure you get your answer in. So 168,000, that's that 180 divided by 910 times the 850. So next topic as we go on. Looking at the difference between a capital expenditure and an immediate expense. Okay, this is Exhibit 7-2 in your textbook. When we make, so let's say we have an asset or we're getting an asset and we make an expenditure. We have to decide whether this is to be capitalized or expensed. And the reason it makes a difference, if we capitalize something, it goes on our books as an asset and we'll depreciate it over time. If we expense it, it goes straight to the expense in the income statement. So extraordinary repairs are capitalized and they're added to the balance sheet. Things that go on the balance sheet that are capitalized are things like overhauling the engine so that we've extended the life significantly beyond its ordinary life. So we've completely replaced the engine. We've added a new wing in a building. We've completely renovated the building for a different use. So these are big ticket capital expenditures. We've added storage capacity to our truck. We have we've bought a van and then we had to go in and completely redo the inside of it to hold the equipment that we need. So we've changed the purpose of it. We've extended the life significantly. Those are all capital expenditures, and they get capitalized, and capitalized being the accounting treatment, not referring to uppercase or lowercase. But we've capitalized them, and they go on the balance sheet as an asset, and we depreciate them over time. The other category is repairs and maintenance. That's when we expense something. So these are things like ordinary maintenance. This is oil changes, changing, lubricating engines, replacing tires. This is ordinary maintenance. Yes, we have to do it to maintain our equipment or it's going to die, but it's an ordinary repair. So it goes as a repair and maintenance expense. So ordinary repairs and maintenance go straight to expense. So these are ordinary repairs. Absolutely, we need to do the repairs or the equipment won't function, but it's still an ordinary repair. So let's do this question. So based on that, which of the following would be capitalized? So let's see. Okay. Okay, so which of the following costs should be capitalized? A, repair of a dump truck's transmission. B, addition of extra storage capacity in a delivery truck. C, oil change on a company car. Or D, painting a company car. So there's one of these items that would definitely be capitalized. So you need to select that one item. We're going to close this in about 10 seconds or so. Okay, the section of your notes, the exhibit 7.2 that relates to this, is recording asset for capital expenditures. So it's talking about which one of these would be capitalized. It's asking which one of these items would belong in the left column, extraordinary repairs, etc., or the other items would be in the repairs and maintenance, which is the right column. So again, we're still doing this question. I'm short of about 10 people or so. Final chance to answer. You also want to make sure, look at the question, look at your answer, and see this screen. Okay. Okay, the left column in that table, the left column are things that would be capitalized. The things in the right column are things that would be expensed. So this question is asking for the things that, the item that would be capitalized, which is the left column. Okay, I think we're kind of leveled off now. Okay, and the item that would be capitalized would be the addition of extra storage capacity. The other items, while necessary, are expensed. Yes? Good, good, good. Okay, so that brings us to the end of class today. We're going to start on depreciation methods tomorrow.